Ever wonder if you could take, say, a modest amount of money and turn it into millions? Not, through pure luck, but using a system.
Like a mechanical approach.
Exactly. Today, we're doing a deep dive into just that. We're synthesizing momentum, scaling into trades, and critical risk management.
And we're drawing on some real legends here.
Sure.
Nicolas Darvas, Ed Seykota. Their ideas are powerful.
Absolutely. So the goal is to see how their insights, even if they seem different at first, can form a unified strategy.
Right. Because Darvas, with his box theory, he gives you that precision timing for entries, those explosive moments.
While Seykota brings the discipline, the risk framework.
Exactly. They complement each other perfectly. I mean, look at the results. Darvas turned 10K into over $2 million.
Incredible. And Seykota.
Seykota supposedly turned $5,000 into something like $15 million. It's about harnessing those huge multi-month moves. That's where the real market profits often are,
Okay, let's unpack the engine driving this. Momentum breakouts. What makes a breakout, well, a real breakout, not just a price blip?
Good question. It's more than just price going up. It's a decisive move outside a defined range, like a support or resistance level. It signals a potential major shift.
And these often come after quiet periods, right?
Precisely. You obviously price consolidate, volatility kind of shrinks, like a coiled spring, then it expands, suddenly.
So contraction before expansion, what confirms it's not a fake out?
Volume. That's critical. You need to see volume surge, maybe at least 50% higher than its recent average, say the 20-day to 50-day.
Why is that so important?
Because that surge, it suggests conviction. Big players, institutions, they're stepping in. It's not just random noise. Often follows chart patterns, too, like a cup and handle, showing that battle ending.
Building cause for the effect, as they say.
Exactly. A longer base often means a bigger potential move.
Okay, so you spot a potential breakout, but before anything else, risk management. Seykota's rules are key here.
Non-negotiable. His 5 immutable rules. Number 1, always, is cut losses.
His famous quote, right? If you can't take a small loss,
sooner or later, you'll take the mother of all losses. It's paramount. Then there's ride winners. And also, really important, keep bets small.
Let's clarify, keep bets small. What does that mean in practice? Risking a small percentage.
Exactly. It refers to the initial risk on any single trade. The idea is to risk a tiny fraction of your total capital, like less than 1%.
So on a $100,000 account, you're risking no more than $1,000 if that trade goes wrong initially.
Precisely. This is psychologically huge. It takes the fear of ruin off the table. If one loss won't kill you, you're actually free to follow the other rule.
Ride winners, because you're not panicking at every little dip.
You got it. You can let profits run without grabbing them too soon out of fear.
Okay, foundation set. Now, how do we build the position? This brings in Darvas and his box theory.
Right. Darvas used a very simple visual method. He'd identify a price range, a consolidation, and draw a box around it. A ceiling and a floor.
And the buy signal.
A breakout above the box ceiling. And crucially, with that high volume we talked about.
Makes sense. And the initial stop loss?
Placed just below the floor of that same box. Your initial risk is clearly defined right from the start.
Now, the scaling part, pyramiding. How does that work without letting risk get out of control?
This is where it's really interesting. You add to your winning position as it forms new, higher boxes. But, and this is key, you add in decreasing amounts.
So maybe a full position initially, then half, then a quarter?
Something like that, yeah. The crucial part is adjusting the stop loss. Each time you add based on a breakout from a new, higher box, you move the stop loss for the entire position up.
Where to?
To just below the floor of that newest box.
Ah, I see. So eventually your stop loss for the whole position moves above your average entry price.
Exactly. Your initial capital is no longer at risk. The trade becomes, in Darvas's terms, effectively risk-free from the perspective of your starting capital. You're protecting profits now.
It sounds very logical, very mechanical, but trading isn't just mechanics, is it? There's the whole psychological battle.
Oh, absolutely. That's the ultimate challenge. Patience is tough. Fighting FOMO, fear of missing out. Buying high feels unnatural sometimes.
And managing a big winning position. The normal ups and downs must feel huge when the position size is large.
Immense pressure. That's precisely why the system is so important. The solution is to trust the mechanics. Focus on executing the rules, not watching every tick of profit and loss.
So the system, the trailing stop-loss mechanism, becomes your anchor when emotions run high.
It's your salvation, really. It takes the decision out of your hands exactly when your judgment is most likely compromised by the stress or euphoria of a big win.
So bringing it all together, what's the main message for you, the listener?
It's that a rules-based system, that fusion of Darvas's entry technique and Seykota's risk control, can provide a powerful framework that helps overcome emotional decision-making.
Discipline over gut feeling, essentially.
Precisely. True mastery here isn't about predicting the future perfectly. It's about unwavering discipline, letting a solid system protect your capital, and just as importantly, letting it ride your winners.
Which leads to a final thought, maybe something for you to ponder.
Yeah, think about this. Where else in your life, outside of trading, could embracing a strict, maybe even mechanical process, instead of just relying on intuition or gut feel, lead to some surprising, maybe even breakthrough success?